It's important to understand what's causing the sell-off and how that's going to impact the different things that you might be trading at the time. For example, the sell-off that we've seen recently really has been spurred on by China and therefore has major repercussions for the likes of the US in particular, who are one of their major trade partners, alongside Australia, of course, and the likes of Canada. So you're likely to get disproportionately larger moves in those markets compared to some other markets. Also be aware of the fact that you should be aware of what you're trading. So different assets have different risks associated with that. The stock market is perceived to be a risky market and therefore you're likely to see big moves towards the downside. People start flying towards the areas such as bonds, which are perceived to be something that people go to in times of weakness, and therefore understand both the markets that you're trading within and the different assets that you're trading. It's absolutely crucial to use stop losses in such a volatile market, but also be aware of the volatility. You know, you can't necessarily place the same size stop losses that you would have in a normal of everyday market movement. Say normally you might put 10, 15 point stop loss. Now all of a sudden you've got to put 100, 200 point stop losses. You really have to understand the volatility and understand how that's going to impact the stop losses that you've got in place. Now, the way that I think actually makes a lot of sense is that once you get that trade move in your favor, and often it can move in your favor quite well because of the size of the market movement, move that stop loss back to break even. That gives you a free trade, and that means that you've got unlimited upside but very limited downside, and it means that any losses are massively limited and you can live another day and live another trade. Much like the stop loss, you've also got to alter the position size. Obviously, if you're going to have to make your stop losses a lot wider, it doesn't make sense that you keep your position size the same size as your normal trade. Now understand that if all of a sudden you've got a very wide stop loss in place, then of course you should be lowering the amount of position that you've actually got on the market, and therefore it should minimize the amount that you're actually losing should it go against you. On a day when there's a massive sell-off, of course, it can move so quickly, and following the usual charts, when people will follow the 4-hour chart, the hourly chart, the half-hour chart, it doesn't really make too much sense. You can't necessarily pick out any sort of trends within the markets because it's moving so quickly. I was following the 1-minute chart, and a lot of people will say they won't touch the 1-minute chart, but quite frankly, that actually gives you some sort of idea of the patterns that are forming within the markets, and therefore, given the size of the moves in very short time frames, it actually allows you to pick up good trades in either directions and actually be able to be quite nimble within the markets. It's important not to have preconceptions about which direction a chart should go. Now, fundamental analysts obviously have a preconceived idea of which direction a certain market's going to go, and they will hold that thought for some period of time. Now, technical analysts should be treating each chart afresh on each day. Look at the chart. Does it tell you it's going to go up or down? And don't necessarily have these preconceived ideas that certain markets are going to go in one direction, even if they're showing you signs of reversing. Just like yesterday when we saw the US Open, we saw it sell off, and a lot of people would have presumed that they were actually going to continue to sell off. But once we started to see those reversal signs, be aware of them and also be willing to change your opinion in the markets within a short time frame.